Do you think trading is just a game of charts and strategies? Then you're mistaken. Because the real game is of your mind and discipline. The book The Art of Trading says that survival in the market is not possible just through technical skills, but through mental balance, patience, and self-control. This book presents trading as an art, where every step and every decision has a meaning. In this video, we will learn how a trader can master their mentality, emotions, and decision-making ability to remain successful in the market for a long time. So, if you want to bring not just money, but also a mature mindset to trading, then definitely watch this video till the end.
Chapter 1, Part 1. Trading is not gambling, but an art that can be learnt with intelligence, discipline, and the right knowledge. This line is the first and most important truth of your trading career. If you think that making money in the market is just a matter of luck, then you are missing a big opportunity. In reality, trading is a science with a deep combination of rules, patterns, and psychology. Understanding and learning this is essential for every new trader. Trading begins with understanding the market. Millions of transactions happen in the market every day, and behind them lie the trends and signals that a successful trader can see. These signals tell you when to buy, when to sell, and when to rest. First of all, you must understand that the market is always right. It does not depend on your wishes, hopes, or fears. It has its own behavior, which is the result of the sentiments of millions of investors. Therefore, the trader who can keep themselves away from emotions is the one who wins. You might be thinking, how can one separate oneself from emotions? For this, the most important thing is your mental preparation. Trading is a mental game. Just as your fitness is important in cricket or football, so is your mental state in trading. Fear, greed, and haste. These three enemies cloud your thinking. Once you learn the basic language of the market such as support, resistance, trends, volume, and patterns, you have to start believing in yourself. Not every pattern or signal in the market is 100% correct. The real art is knowing when to trust it and when not to. To achieve success in trading, the most important thing is a well-organized plan. Trading without a plan is like going into a jungle without a map. Your plan will tell you when to enter, when to exit, and how much risk you are prepared to take. At the same time, it will also determine when you will stop if there is a loss. In India, many people consider trading only as a means of making quick money. But those who want long-term success have to go deep into the market. Some rules in the market are the same everywhere, but in an emerging market like India, special strategies have to be adopted, such as considering the impact of the local economy, government policies, and foreign investment. From a marketing perspective, trading is a business where your biggest customer is yourself. If you learn to understand your mind, your trading decisions will be made more wisely. This is only possible when you control your emotions and build psychological understanding along with technical knowledge. Successful traders constantly update their knowledge. The market environment, rules, and technology keep changing. If you remain stagnant and stop learning, the market will leave you behind. Therefore, traders' greatest strength is their eagerness to learn and their patience. The thing that sets trading apart the most is your risk management. No matter how much you analyze, there is always uncertainty in the market. So, it is important to manage risk with every trade. It is essential to know how much loss can be tolerated in a single trade and no more. The next thing is to follow the trading plan. Often, traders make a plan and then abandon it. But traders who achieve success in the market strictly follow their rules even when the market fluctuates. Success in trading is difficult without discipline. To understand trading, you need to know various market tools and techniques, such as chart analysis, indicators, and trading signals. These give you hints about which way the market might go. However, every tool has its own limitations, so it is important to have a balanced perspective. Especially for retail investors in India, it is important that they trade wisely and do not rely on tips or rumors. Making decisions out of fear or greed during a bull or bear market can lead to big losses. There is nothing more important in trading than mental stability. If you understand your mood and mental state, you can avoid emotional decisions. Therefore, trading is a profession where self-awareness and control are most important. At the same time, it is also important to know that not every trade is successful. Learning from losses and not rushing makes a good trader. In the market, patience is the greatest asset. The biggest advantage of trading is that it leads you towards financial freedom. If you adopt the right knowledge, discipline, and the right strategy, then your success in the market is certain. But for this, constant practice, correct decisions, and mental fortitude are required. From a marketing perspective, by learning the art of trading, you can make your financial life stable and secure. This is not magic, but a well-organized process that requires constant improvement and learning.
Chapter 1, Part 2. In the world of trading, the first rule is that nothing is more important than education. Stepping into the market without the right information is as dangerous as riding a bike without a helmet. You need to understand the market's rules, tools, and strategies deeply. It is often seen that when new traders hear about someone making a big profit, they start imitating them. But remember, everyone's situation is different. Your success depends on your own understanding, experience, and discipline. The faster you learn in trading, the faster you can save yourself from losses. Mistakes will happen, but it is important to learn from them. Every loss in the market makes you a better trader if you take the right lesson from it. In simple terms, trading means making the right decision at the right time. The basis of this is market analysis, which is of two types: fundamental analysis and technical analysis. In fundamental analysis, the financial aspects of a company, country, or economy are examined. In technical analysis, future market movements are predicted by studying charts and data. In a country like India where the economy is changing rapidly, knowledge of fundamental analysis becomes even more important because government policies, economic reforms, and the impact of the global market directly affect your investment. Is the market's momentum in favor of my stock? Do the news or sentiments support this momentum? Is the risk-to-reward ratio suitable for my entry? If the answer to all four of these questions is yes, only then should you trade, otherwise not. This system will make you an expert in timing. Now let's talk about backtesting and practice. If you want to play cricket well, you will practice in the nets. Similarly, in trading, you have to do paper trading. That is, trade virtually by looking at charts without investing real money and see if your decisions are correct. This practice will teach your mind how to see and understand signals. There is another way to strengthen your sense of timing: understanding a stock's own personality. Not every stock behaves the same way. For example, Reliance is a stable stock with large moves, whereas Tata Motors is volatile. Sudden spikes or falls are common in small cap stocks. So, understand the movement of each stock and create your timing accordingly. Now let's come to a less understood but extremely necessary aspect: intraday timing. If you do intraday trading, you need to know that in India, the first 15 to 30 minutes after the market opens are the most volatile. During this time, big players change their positions and the crowd is in confusion. So for the first 15 minutes, just watch. Then decide. The time from 10:15 am to 11:30 am generally is a good time to take a trade, because by then the market's mood has become clear. Similarly, the time after lunch, that is from 2 pm to 3 pm, is suitable for the final move of the session. Position sizing also plays a big role in timing, that is, how much money you invest at once. You should place a big bet only when the timing is clear and the signal is strong. If the situation is unclear, it is wise to start with a small size. Another thing that traders in India should understand quickly is to avoid overtrading. If you trade 4 to 5 times a day, your focus is not on timing but only on action. And more action means more mistakes. So before taking a trade, ask yourself, is this trade following my rules? Is it wise to enter now or should I wait? Every time you do this, you learn to communicate better with time. Now the question arises, what can be the success rate of this system? No system is 100% successful, but technical analysis gives you a framework through which you make decisions based on probability, not on feelings. This is why every successful trader in India has a trading journal where they record every entry and exit. You too should write in your diary, why did I take this entry? On what basis did I take it? And what was the result? This habit will improve your timing day by day. Finally, the most important thing is that timing requires patience and patience requires discipline. This is a skill that develops slowly, but when it is developed, it takes you to the category of those 10% of traders who make profits year after year. Remember, making money in trading doesn't just happen with a good strategy, but by applying that strategy at the right time. And this is only possible when you control your mental state, read the market signals attentively, and patiently wait for the right opportunity. Chapter 5, Part 1. Every successful trader has a special quality. They see the market not as a battlefield, but as a flowing river. They know that when you move with the flow of the river, you reach the shore more easily and safely. But if you swim against that flow, you get tired and can also drown. This same principle applies to trading, understanding the direction of the market and moving with it. This is the science of trend following, and in this chapter, we will talk about it in detail. Many new traders see trading like this. It's going down, let's buy. It will go up soon. An upward trend is an uptrend, a downward trend is a downtrend, or it can be sideways, meaning without a clear direction. In an uptrend, each new high is above the previous high and each low is above the previous low. In a downtrend, each new low is below the previous low and the high also moves down. When neither of these happens, meaning both highs and lows fluctuate within a limited range, then it is a sideways market. Most traders suffer the most losses in a sideways market because they think they are catching a trend, but in reality, they are confused. So the first rule is not to make any big decisions without confirming the trend. Now the question arises, how to confirm the trend? For this, the two most popular and reliable tools are moving average and trend lines. If the price is consistently above the moving average and the moving average is leaning upwards, it indicates a potential uptrend. If the price is going down and the moving average is also leaning downwards, it indicates a downtrend. Many experienced traders in India like Rakesh Jhunjhunwala or Vijay Kedia have adopted this method. They identify the trend, enter it and stay for a long time. They have given time to the market and in return the market has rewarded them. But common people say, I don't have that much time, I want quick money. This mentality prevents them from following the trend. Another interesting way to understand the trend is sector analysis. Sometimes in the market an entire sector trends. For example, if there is momentum in the banking sector, then SBI, ICICI and Axis will all move together. If the auto sector is emerging, then Maruti, Tata Motors and Hero MotoCorp will all show life. So you have to look not just at the stock, but at the movement of the entire sector. Similarly, sometimes the trend is not just in the Nifty or Sensex, but in the mid-cap or small-cap index. So you have to be alert about where the real movement is happening. Now let's come to a common mistake, trying to catch a trend reversal. Many new traders try to trade in the opposite direction before the trend ends, meaning they try to catch the top or bottom. The best approach for you is to consider that a trend is a trend until it breaks. In other words, follow the trend until it reverses and exit when the trend breaks. Its ultimate formula is, the market will always test your patience before giving a profit. If you don't show patience, the market will only give you false signals. But if you understand the trend over time and mentally stick to it, that trade will give you the most returns. So the next time a stock is running up or down, don't ask it, where will you go now? Instead, ask yourself, are you giving me a signal that I can trust? And if the answer is yes, then go with it. Because this is the real art of trading. Flowing with the current, entering at the right time, and sticking with it patiently. Chapter 5, Part 1. Every successful trader has a special quality. They see the market not as a battlefield, but as a flowing river. They know that when you move with the flow of the river, you reach the shore more easily and safely. But if you swim against that flow, you get tired and can also drown. This same principle applies to trading, understanding the direction of the market and moving with it. This is the science of trend following, and in this chapter, we will talk about it in detail. Many new traders see trading like this. It's going down, let's buy. It will go up soon. An upward trend is an uptrend, a downward trend is a downtrend, or it can be sideways, meaning without a clear direction. In an uptrend, each new high is above the previous high and each low is above the previous low. In a downtrend, each new low is below the previous low and the high also moves down. When neither of these happens, meaning both highs and lows fluctuate within a limited range, then it is a sideways market. Most traders suffer the most losses in a sideways market because they think they are catching a trend, but in reality, they are confused. So the first rule is not to make any big decisions without confirming the trend. Now the question arises, how to confirm the trend? For this, the two most popular and reliable tools are moving average and trend lines. If the price is consistently above the moving average and the moving average is leaning upwards, it indicates a potential uptrend. If the price is going down and the moving average is also leaning downwards, it indicates a downtrend. Many experienced traders in India like Rakesh Jhunjhunwala or Vijay Kedia have adopted this method. They identify the trend, enter it and stay for a long time. They have given time to the market and in return the market has rewarded them. But common people say, I don't have that much time, I want quick money. This mentality prevents them from following the trend. Another interesting way to understand the trend is sector analysis. Sometimes in the market an entire sector trends. For example, if there is momentum in the banking sector, then SBI, ICICI and Axis will all move together. If the auto sector is emerging, then Maruti, Tata Motors and Hero MotoCorp will all show life. So you have to look not just at the stock, but at the movement of the entire sector. Similarly, sometimes the trend is not just in the Nifty or Sensex, but in the mid-cap or small-cap index. So you have to be alert about where the real movement is happening. Now let's come to a common mistake, trying to catch a trend reversal. Many new traders try to trade in the opposite direction before the trend ends, meaning they try to catch the top or bottom. The best approach for you is to consider that a trend is a trend until it breaks. In other words, follow the trend until it reverses and exit when the trend breaks. Its ultimate formula is, the market will always test your patience before giving a profit. If you don't show patience, the market will only give you false signals. But if you understand the trend over time and mentally stick to it, that trade will give you the most returns. So the next time a stock is running up or down, don't ask it, where will you go now? Instead, ask yourself, are you giving me a signal that I can trust? And if the answer is yes, then go with it. Because this is the real art of trading. Flowing with the current, entering at the right time, and sticking with it patiently.
Chapter 5, Part 2. Your biggest enemy is not the market, nor any other trader. Your biggest enemy is the person you see in the mirror every morning. In the world of trading, emotions are like a double-edged sword. On one hand, they alert you, but on the other, they can also mislead you. If you don't control your emotions, even the best strategy can fail. This is where mental practice comes in. Every professional athlete, pilot, or soldier mentally prepares for difficult situations through practice. A trader should do the same. Every morning before the market starts, ask yourself, if my trade goes against me today, what will I do? If my stop loss gets hit, will I be able to stay calm? If some strange news enters the market, will I get carried away by emotions? Through this mental preparation, you start to control your inner reactions, and this separates you from the 90% crowd that only reacts. Now let's talk about an aspect that most people ignore, the trading journal. Every professional trader has a journal where they record every trade, which stock it was, why I bought it, when I bought it, how much I bought, when and why I exited, how I was feeling, whether I followed the plan, and what I learned. This journal becomes your mirror through which you can catch your mistakes, understand your behavioral patterns, and gradually improve yourself. Now let's talk about the most dangerous emotion, overconfidence. When 2 or 3 trades go right, a trader starts to think that he has understood the market. The downfall begins from here. Because overconfidence forces you to increase your risk, incites you to break rules, and gives you the belief that, I can't be wrong now. Therefore, humility is the greatest virtue in trading. A good trader always thinks that they can be wrong at any time. They never fight with the market. They just read it, and when the signal changes, they quickly adapt, without ego or hesitation. Another important thing is to take breaks. Continuous trading, constantly looking at the screen and reacting to every movement, increases mental fatigue. And when the mind is tired, decisions become weak. So a good trader should not trade for long stretches at a time. This restraint will keep you going for a long time. Now think about it for a moment. Have you ever adopted a reward system? Meaning, when you execute a perfect trade according to your plan, Whether it results in a profit or a loss, reward yourself. Because this sends a signal to your mind. You are doing the right thing. Following the plan is good. Through this positive reinforcement, you can improve your habits. Finally, I want to share an idea. A trader's job is to forecast the market, but this is a test not of your knowledge, but of your character. And if you can look inside yourself every day, acknowledge your emotions, and trade by keeping them in balance, then believe me, your growth will not only be financial, but also mental and spiritual.
Chapter 6, Part 1. If you had to answer one question, why do you trade? Your answer should reflect a strategy, not just an emotion. Many people trade because they think they can make quick money. But those who survive for a long time and make money consistently never trade with emotion, but with a system. Every trader needs a system that keeps them disciplined every day, limits emotions, and makes room for logic. But what does systematic trading mean? It means you conduct every trade under a predefined process, not based on whether you are feeling good or bad today. In systematic trading, the decision-making process is predetermined: which indicators you trust, which setups you follow, and which situations trigger your entry and exit. All of this is part of the system. A big advantage of systematic trading is that it gives you stability in volatility. When the market is uncertain and every news channel is shouting, "A crash is coming," a systematic trader does what the system says, no more, no less. This is why the world's most successful traders, be it Mark Minervini or Ray Dalio, all have a clean and tested system. Now let's discuss what a basic but effective trading system should contain. 1. Trade setup. You must decide which signals you will trade on. Do you look at moving average crossovers? Do you pay attention to volume breakouts? Are RSI or MACD important for you? A good system makes it clear when you should be interested and when you should ignore. 2. Entry rules. Do you jump into a trade as soon as you see a setup? Or do you wait for confirmation? Many professionals adopt a confirmation strategy, waiting for a second signal or candle after the first one appears. This helps to avoid false breakouts. 3. Stop loss and position sizing. A systematic trader knows in advance how much money they can lose in a single trade. They do not risk more than 1 to 2% on a single trade. If the trade fails, the loss is limited. 4. Profit target and exit rules. It's not just important to enter. Knowing when to take profit and exit is equally important. Many times a trade is successful, but the trader cannot book profit due to greed, and the profit decreases or disappears. The system determines in which situations you will take profit. Do you use a trailing stop? Do you exit at a specific technical level? 5. Review and optimization. No system is perfect. After every month or every 20 to 30 trades, a systematic trader reviews all their trades. How many trades were successful? Where did things go wrong? Should improvements be made to the setup? Has the market's momentum changed? This process keeps the system alive and updated over time. Now, is it easy to create a system? Honestly, no. Because creating a system is not difficult. Trusting the system is difficult. Many times the system says don't buy, but the mind says, let's buy at this time, it feels right. Or the system says sell now, but an inner voice says, let's wait a little longer for more profit. This is the real test, whether you can work like a machine that does not deviate from its rules. A good system is one that is back-tested, meaning you have tested it on data from previous years. Back-testing provides two things: an estimate of the system's success rate and increased confidence in it. A successful system is born of simplicity. You can create complex systems, but remember that a system is built on past data, not for the future. Therefore, simplicity is crucial. Another important aspect is no-action discipline. Not taking any action when the system gives no signal. Sitting with the screen open but not making a trade because the system doesn't allow it is also a skill.
This skill separates you from the 95% who get trapped by rushing. Another point, systematic trading does not mean you will never change. The market changes, and you have to test and evolve your system accordingly. But that change should also come from a process, not from an emotional decision. You should test your system for at least 50 trades before making significant changes.
Chapter 6 and 7 combined. The process starts to challenge your mind. For example, your system says to buy if a stock crosses the 20-day moving average with increased volume. But on the day such a setup appears, some negative news comes out, and your mind instills fear. Should I really buy? Or when the system hits a stop loss, your mind says, if I had waited a little longer, it might have come back up. This is the real test. Following the system is not difficult. Following it consistently is difficult. The human mind is never still. It constantly creates new assumptions. Therefore, the most important thing in systematic trading is self-awareness. You have to understand the tricks of your mind and calm the voice that urges you to break the rules. If your system has a 60% success rate, it means it will fail 4 times out of 10. You have to accept this failure, which is often hard because our ego says, I can't be wrong. You must overcome your ego to follow your pre-decided plan. Another practical cycle is revenge trading. After a loss, a trader often rushes into another trade to recover the money, usually outside the system, which leads to further losses. This is the emotional loop of losses. The only way to escape the cycle is to take a break. A systematic trader pauses after every loss, knowing that losses are part of the process. The biggest mistake in trading is believing that once you have created a system, you will always win. The truth is, the market is never the same. If your system doesn't evolve, it will become irrelevant. Thus, it's essential to evaluate, adapt, and refine your system. This process is as much mental as it is technical. Evaluation. Every professional trader keeps a trading journal. It's their most trusted companion. They record every trade, including the mental state and reasons behind it. To improve the system, you need behavioral data, not just performance data. Adaptation. Every system is designed for a specific market condition, trending sideways. When the market's mood changes, the system's performance also changes. A mature trader understands whether poor performance is due to breaking rules or the system being out of sync with the market. Before changing the system, ask, have I followed the rules? Has the market truly changed? Can a small tweak improve it? Refinement. This means gradually improving the system by adding filters like volume confirmation, reviewing time frames, or adjusting position sizing. Avoid curve fitting, making the system so perfect on past data that it fails in the real market. Keep the system simple and robust. Chapter 8 combined. No matter how good a trading system you follow, if your mindset isn't clear, every decision will be blurry. The real battle of trading takes place inside your brain. It's not about beating the market. It's about understanding and controlling yourself. We start with a harsh truth: fear of missing out. FOMO. FOMO is the emotion that drives even the calmest trader crazy. It stems from the belief that another good opportunity won't come. But a real trader knows opportunities are infinite, but capital is not. FOMO's sister is overtrading. This is when a trader trades repeatedly just to feel active. But professional traders understand that silence is a strategy. Not trading is also a valid decision. Then there's hope trading. When a trade goes against us, we hope it will come back. Professionals don't hope. They cut their losses. They are not blinded by hope because the market doesn't care about their feelings. Another deep psychological pattern is confirmation bias. We tend to see only what supports our existing beliefs about a trade. A professional trader always asks, is this setup coming from the chart or from my assumption? Emotional anchoring is when your mind gets stuck on your entry price, preventing you from making objective decisions as the price moves. Professionals detach from their entry point and see each new candle as fresh information. Revenge trading happens after a big loss, leading to impulsive trades to recover money, which almost always results in deeper losses. Professionals take a break after a loss to regain objectivity. Comparison syndrome, fueled by social media, leads to self-doubt and haste. A professional trader doesn't compare.
They focus on their own journey and continuous improvement. Finally, there's mental fatigue. Trading is mentally exhausting. Experienced traders set fixed trading hours and value offline activities to rest their minds. A successful trader has a strong mental framework. This includes admitting mistakes, a desire for continuous learning, self-belief, patience, and emotional control. The most crucial element is unwavering belief in your trading plan. Discipline is the quality that helps you follow your rules and protects you from emotional storms. Also vital are mindfulness, focus, and adaptability to changing market conditions. Patience is a great virtue. Big opportunities often come to those who wait. Trading is a continuous journey with no final destination. This is the art of trading, to be the master of your story, not its victim. It's about turning your mind into a skilled, disciplined tool that remains stable amidst market volatility. If you adopt this mentality, your trading life will not only be successful, but you will also grow stronger as a person.